blessed day. This is Maria Victoria Soriano Trinidad, a teacher of Dagupan City National High School, Senior High School, under Accountancy, Business and Management strand of academic track. My subject is Business Finance. I am here to discuss to you the Module 1 in Business Finance, the major rules of financial management. After reading this module, the learners will be able to explain the major rules of financial management and the different individuals involved. The aims of these modules is to demonstrate an understanding of the definition of finance, the major rule and functions of financial management, the individuals involved in the activities in financial management within an organization, and the form of business organization. Let's have the introduction. Finance plays a very important part in people and business enterprise. No organization and no household can live or exist without finance. People needs funds. Organizations needs funds. So let's define what is finance is. If we say finance, it is concerned with identifying, evaluating, and managing sources and use of cash in order to increase the value of the business enterprise to its present owner, according to Saldana, 1997. But Medina 2007 defined finance as the study of the acquisition and investment of cash for the purpose of enhancing value and wealth. Finance and financial decisions are part of our daily lives. Individuals needs finance. Families, society, and profit and non-profit organization. Obtaining and using credit, making investment, managing funds, obtaining capital, and even spending for one's daily needs like food, clothing, and shelter are all activities that involve finance and financial decision. There are three major rules of financial management: the liquidity, profitability, and management. Under liquidity are the forecasting of cash flows, raising of funds, managing the flow of internal funds, while the profitability are cost control, pricing, forecasting future profit, and measuring cost of capital. And management are the management of long-term and short-term of funds. Let's proceed now with the functions of financial management. There are three: the investing or investment, the financing, and dividend decisions. Under investment decisions are the capital budgeting and working capital management, while financing decisions are the cost of capital, capital structure decision, and leverages, while the dividend decisions are the dividend policy and retained earnings. If we say capital budgeting, it means that the long-range planning of allocation of funds among the various investment proposals. And the total capital management represents the total components that make up current assets. It can be computed by adding company's cash, marketable securities, account receivables, inventory, and prepaid expense. To illustrate this one, let's have this example. Suppose this KY company has current assets of 500,000 pesos and current liabilities of 300,000 pesos. Fixed assets are 100,000 pesos and long-term debts is 100,000 pesos, while the short-term debt included in the current liability is 25,000 pesos. So we're now going to calculate the working capital. The answer there is 775,000 pesos. To continue with the functions of financial management, we're going to define the capital management, wherein it is an accounting strategy that strives to maintain sufficient and equal levels of working capital, current assets, and current liabilities. This helps a company to meet its expense obligations while also maintaining sufficient cash flow and is primarily related to short-term financial decisions. The financing decision or the debt to equity. Cost of capital. It is the cost of companies' funds for both debt and equity, and it is used to evaluate new projects of a company. If we say debt, it is an obligation that requires one party, the debtor, to pay money or other agreed upon value to another party, which is the creditor. Equity. It is an ownership of assets that may have debts or other liabilities attached to them. The capital structure decisions. It is the way the corporation finances its assets through some combinations of equity, debt, or hybrid securities, while leverages are the use of the fixed charges sources of funds such as debt and preference capital, along with the owner's equity in the capital structure. Let's proceed with the dividend decisions or the retained earnings to dividends. Dividend policy. It is concerned with financial policies regarding paying cash dividend in the present or paying an increased dividend at a later stage. It is the policy a company uses to structure its dividends payout to shareholders. If we say shareholders, it is also known as stockholder. It is an individual or institution, including a corporation, that legally owns one or more shares of stock in a public or private corporation. Shareholders may be referred to as members of a corporation. Retained earnings. It is the accumulated net income of the corporation that is retained by the corporation at a particular point of time, such as the end of the reporting period. It is the percentage of net earnings not paid out as dividends but retained by the company to be reinvested in its core business or pay debt. It is also called the retention ratio or retained surplus. To illustrate this, let's have this example. Using the formula of the retained earnings, wherein the retained earnings or RE equals beginning retained earning plus net income minus dividends. Let's have this illustration. The total retained earnings at the beginning of the period is 300,000 pesos, and the net income is 287,000 pesos, while the dividends is 17,220. So, using the formula of the retained earnings, we're now going to add the net income of 287,000 pesos to the retained earnings at the beginning of the period, which is 300,000 pesos. And then, we're going to deduct the dividends, which is the 17,220 pesos. The total retained earnings at the end of the period is equal to 569,780 pesos. Let's proceed now with the last part of the lesson, the forms of business organizations. There are 3 forms of business organizations: the sole proprietorship, partnership, and the corporation. If we say sole proprietorship, it is a business owned by one person and operated for his or her own profit. The advantages are the following. It is ease of formation, needs only minimum capitalization, sole decision maker, and easy to terminate. While the disadvantages are the unlimited liability, the limited access to capital, limited skills, talents, and capabilities, the inability to attract or retain good employees, limited term of existence, difficulty in measuring success, personal problem may hinder the operations or the success of the business. The second form of business organization is what we call now the partnership. It is an association of 2 or more persons who have agreed to contribute money, property or industry to a common fund with the intention of dividing the profits among themselves. The advantages are the following. It allows pooling of financial resources. It allows pooling of skills, expertise, and experience of partners. And last is the less government control, supervision, and intervention. While the disadvantages are the limited life, unlimited liability, and mutual agency. There are types of partners as to liability of partners. The general partnership and the limited partnership. General partnership is one in which all of the partners are general partners, while the limited partnership is one in which there is at least one, but not all limited partners. And then there are types of partners as to liability, the general partner and the limited partner. General partner is one who has unlimited liability, while limited partner has limited liability. As to investment in the partnership, there are three: the capitalist partner, the industrial partner, and the combination of both capitalist and industrial partner. Capitalist partner is a partner who contributes money and or assets other than cash like building, land, or equipment, while the industrial partner is a partner who contributes knowledge or personal service, while the combination of the capitalist and industrial partner is a partner who contributes cash and or other assets and knowledge or personal services. So let's take the last form of business organization, the corporation. It is an artificial body or being organized in accordance with the provisions of law, in which ownership is divided into shares of stocks. There are 6 advantages. The first one is separate legal existence. Second, created by operation of law. Third, transferable units of ownership. Fourth, limited liability of stockholders. Fifth, continuing existence. And sixth is the centralized management by the board of directors. And the disadvantages are the following: the conflict with stockholders and board, and double taxation, and of course, the extensive paperwork. And that's the end of my lesson. So, my dear learners, are you ready to take the activities? If you are now ready, sabay-sabay nating bigkasing, handang isip, handa bukas. Tara na! ML na tayo. Thank you so much and God bless.